Hi there, everyone, and welcome to another edition of On Track. My name's Rob McGregor. It's the 28th of June as I record this, so closing in on the end of the financial year, and we've got news and charts right up to date, performances to the end of May and updates since. Lots going on, lots of fears, big market downturn. I'm going to get into all the explanations shortly, but firstly, as always, just a quick general advice warning. This video is prepared for clients at McGregor Wealth Management, particularly those who use our care investment methodology and portfolios. To anyone else who watches this, please enjoy it. But a reminder, you should seek advice that's specific to your own circumstances. I'm going to cover, as always, the latest economic news. Lots going on in the market, so I want to put it into context of what it means for your portfolios. I'm going to talk about the main focus, which is this fear at the moment that inflation is going to get stuck and that interest rates are going to have to go up to tame inflation, and we may get a 1970s type stagflation, which everyone wants to paint as really horrible. And I'm going to take you back and have a look at some of these things and put into perspective about where we are. So the news, as I said, share markets have fallen in Australia at the peak of the downturn, around 15%. The markets look like they're bouncing back at the moment. We've had cash rates go up. If you look at the table down the right-hand side, and I've shown the last 3 months here just to show how quickly things have changed. 2 months ago, we still had a cash rate of 0.1, then they put it up by 0.25, then by another 0.5%, so to 0.85%. And that's resulted in mortgage rates going up by the same amount, pretty much across the board. 90-day bank bill rates are up 1.3%. 10-year government bond rates are up. They did get as high as 4%. They're back to about 3.7. I'll talk more about that later. Aussie dollar a bit weak at the moment, down about 0.69. Annual inflation, we're waiting for the next. Australia only updates its inflation numbers quarterly. So next mid-June, we'll get the next number. The governor of the RBA has predicted that inflation will get to about 7% in Australia before declining back to the 2 to 3% range in 2023. Now, he's under a lot of pressure because he told everyone interest rates would stay lower for longer. And the reason they haven't is quite simply the world's got back to normal much quicker than the Reserve Bank were predicting. And part of that is because of the good job they did in pumping money into the economy. So they're now copying it for not predicting everything perfectly, but it was a tricky old world. You wouldn't be in their shoes for quids. US inflation still sticking stubbornly high. Similar message from the US Federal Reserve. They do think they're going to get it under control. They're looking to have some big jumps. They jumped interest rates this month by about 0.75%. Now, most of the market downturn came before they increased interest rates. Once they did increase interest rates, the market started to stabilize because it became known news. And keep in mind, for markets to get worse, the news has to get worse. So just confirmation of bad news is neutral. And if the news is less bad, it's actually positive for the market. So really important point, because when we've had fears of bad news, and throughout this, there's fears of recession, fears of stagflation. When we've had fears of things, as news comes out that looks like it's maybe not quite so bad, markets will often rebound quite dramatically. And that's certainly a possibility here. We've had the fear that property prices are going to fall. I'll give you the latest on property prices towards the end of this, but they've come off the boil, but they've hardly crashed and they're still up solidly over the last year. And the world is opening up post-COVID. Lots of people are traveling, not as many as pre-COVID, but the numbers are on the rise, and I'll show you some figures around that as well. And our new Labor government has a whole bunch of stuff to deal with, from Pacific security to trying to get back on the good books with China, to the rise in energy prices. So certainly a busy start. Mortgage rates just down the bottom there too. The lowest variable rates have jumped by about 0.8%, pretty much the same as the RBA cash rate. Variable rates of Macquarie have jumped about 0.7, and 1 year term deposits, it's interesting, last month they jumped to 2.75, even with the rise in the cash rate. Term deposits haven't gone up anymore, so I suspect they may have peaked. That means the banks, by the way, are increasing their profit margin because they're lending at higher rates, but the term deposit rate is staying stable. Now, it's a lot more complicated than that, but it's not necessarily bad news for banks, even though they've been under fire as well. So let's have a look at from our friends at Trading Economics. There's a whole lot of data here. I just want to give some general stuff around what's happening in the world economy. And the red circle there in the middle, I've got inflation rate. It's on the rise everywhere. So across the world, not as bad for us in the West as, say, Russia and Brazil, but certainly the US at 8.6%, as we mentioned, Australia at 5.1%. These are higher inflation rates than we've had since the 70s and 80s. And this is driving this fear of potential that banks around the world, federal reserves around the world are going to have to put up interest rates. That's going to hurt the economy. That's going to cause a slowdown. And that's what's caused this current dip. Some of the good news that's still here at the moment is unemployment, or the jobless rate, is very low by historical standards in the West. In the United States, 3.6, in Australia at 3.9. They're very, very low rates. So that's a good sign. We've also got massively high savings rates from the last few years. So that's a good sign going into any downturn, because the key fear here is that rising mortgage rates hurt businesses and hurt borrowers, so they will spend less, and that slows down GDP. And there's, of course, merit to that fear, but having high savings rates to start with helps mitigate that somewhat. GDP is still growing strongly at this stage, although a red circle there, the US had a negative quarter last quarter, that's to March. If they produce that in June, they will have had a slight recession, but it will be a very modest recession compared to history. So let's have a look at portfolio returns, and these returns are only to the end of May. June will be a lower number again. So the month of May was negative to the tune of about 1.2%, depending on portfolios. That'll be a little bit more for June. Longer term returns solid, but they've declined as well. So you can see 5-year returns, 3, 5, 6, 7, and nearly 8. Considering inflation during the last 5 to 7 years has been about 1.5%, these numbers are still reasonably in line with what we planned for your long term. And whatever you measure at the bottom or during a downturn in market cycle be the worst. And obviously, as we get recovery, that will go up. We've kept our market dial still at fair. We do that with some degree of caution in a few fronts. One, you'd think if markets drop, we would lower that. But the reason markets have dropped is because of this fear of recession. And if we do get not even a recession, but even a slowdown, it does slow down earnings of companies, and that does reduce their valuations. And the other factor with valuations is they're affected by interest rates. When interest rates are higher, people want more, they want more reward from their shares, so they're only willing to pay less. So even though markets have come down, we've kept that at fair. That could change very quickly to cheap if earnings hold up, which is a possibility, or if interest rates don't rise as much as some people are speculating, which is also a possibility. Cautious, but very comfortable investing at the moment. And certainly shares are on sale, 15% off compared to last month. Very important to be mindful of the dangers, and I'll talk about some of them. When markets are down, the obvious one is panicking and sell, or becoming more defensive. We know the costs of these biases, and there's lots of them, means that the average investor underperforms their investments by 3 to 5% over the long run. So this is where you make your money, by sticking with your strategy, by sticking with the plan. This is where you make the money. People that lose money in the long run, the biggest mistakes they make are during these downturns in the share market. I want to talk about the 7 downturns we've had of more than 12% since GFC. And I just want to reiterate the point. Some of you may have heard me talk about this. We get a correction, and share market terms, a correction is a downturn of more than 10%. A bear market is more than 20%, and a crash might be more than 30%. But we get a correction on average every 1.6 years. So these things are frequent. And I went back and counted the number of downturns of more than 12% since GFC, which is effectively the last 14, 15 years for us. and there's been 7, so about once every 2 years for more than 12%. Because this one at the bottom was about 15%. The market's rebounded a little bit from there. So down about 15%, 36% in COVID, and then there's 1, 2, 3, 4 more that are between 12 and 17%. Now, some of you that have been in the office lately, I've sort of teased a little and said, of course, we all remember the cause of all those ones, don't we? And the answer is none of us do, and no one has. And that we forget these ones very, very quickly. We remember the big ones. We remember the COVID downturn, which was 36%. Remember GFC, which was nearly 50%. So they stick with us. We'll remember the 1987 crash, 1929. So remember those for a long time. And we're always worried about another one of those. But these little ones in the 10 to 20% range, we forget very quickly. Let's have a look at some of those reasons. The one in 2018-19, down of 12%, was fear of tightening, plus trade wars between the US and China stepping up a bit. So fear of interest rates eventually going up. This was all before COVID. So it was a different world. If you go back to 2017, there was a fear of slow growth and fear of falling oil prices. We've now got a fear of rising oil prices. So the market seems kind of crazy, and fears falling oil prices, fears rising oil prices. And what the market doesn't like is unexpected news. And that's why we often have downturns if it looks like the narrative has changed. Back in 2012, we had the fear of the European crisis, particularly around the Greek. You remember there was rumours that Greece might have to leave the European Union and might default on all its debts. And a couple of years before that, there was a 12% downturn on fears that the global economy would get worse. So these things tend to rinse and repeat. And after they've passed and recovered, we all forget them completely. We do remember the big ones. We certainly hope this one won't be a big one. I don't think it has the characteristics to be a big one. There's no certainty, and I'm no better predictor of these things than anyone else, but we do monitor the conditions that are more likely to lead to big downturns, and certainly don't think this has the potential to be one of them, but can't be certain as always. What's the bond markets telling us around interest rates? You'll see on the left the Australian yield curve. So this shows the interest rates from cash at the left-hand end, and the blue is the current as at the 27th of June. So we can see long-term bond rates from about 10 years forward, about 3.7 and then 4%. So this is the Australian bond market telling us that it thinks inflation is going to end up just under that. In a normal world, inflation would be about 1% under the bond curve. Now, it does go up and down. So it's actually saying it believes the Reserve Bank that it's going to get inflation sort of under that 4, under that 3%. Now, it's gone up a lot in the last 6 months. You see the orange plot is from 6 months ago, hence we've had that big increase. But it's gone up less in the last month and just gone up by a little. There's pretty much the same story in the US, although the numbers are lower. US 10-year bonds at just over 3%, so a bit less than in Australia. So once again, it's saying it does think inflation will run through. And there's a few other signs that show that the markets, the long-term markets, and if you think about the players in the market, you've got the media and the speculator who are obsessed, the speculators who are obsessed with what's happening in the short run. So every bit of bad news at the moment, they're jumping on predicting Armageddon, as they do. That's their nature. But the long-term investors, and that's the long-term share investors, but also long-term bond markets are saying, well, I don't think this actually looks as bad as the short-term people predict. I tend to be in that camp. I think, and once again, can't predict with any certainty, but I think inflation will prove a bit more stubborn than we thought, but not as stubborn as during the 70s. And only time will tell. I want to just confirm that as bond rates have fallen, so as bond rates have come down, we've seen losses in government bond funds of about 7 to 10%. Now, what that means is defensive investors, for the first time since 1992, have had negative returns from shares and negative returns from bonds. So this is a table from the Lonsec survey, and you can see this is conservative, sort of 20 to 40% of growth assets. And you can see the range in the last 6 months in particular. The worst performance is -8%. The best is flat, just -0.22%. We sit reasonably well in that in our conservative portfolios. And yeah, we sit long-term very well in those portfolios, certainly in the top quartile and number one for our core portfolio, our moderate portfolio. But the ones that have done the most damage are the ones that hold a lot of government bonds, or they hold the index in government bonds, which has a duration of about 7 years. And the index for bond markets is down about 7 to 10%. So it's a troubling year for cautious investors. It's a tough one. It's the first time we've had a negative year for conservative funds since about 1992, where bonds have also contributed to a downturn at the same time as share markets down. So once again, in the context of our cycle, boom, bust, wall of worry, we're absolutely in the worry part of the cycle. People are worried about everything. Last week, when the markets were bottoming, as at the moment it looks like a bottom, it may get worse, but for now it looks like a bottom. There was a lot of fear. I had the fear index right up there, but there's a lot going on. So that's just one element, investor sentiment, and it was quite fearful. I find you guys, our clients, are not fearful. Some of our newer clients have a lot more concern at stages like this, and completely understandably so. But for most of our clients who've been with us for long periods of time, they know that this is just another one of them, being another downturn that eventually will pass. And we know that if we survive these, we prosper strongly. The psychology of the markets, once again, generally all of these downturns, except for COVID, came after big booms. We certainly haven't had a big boom, although it's fair to say the US had a tech boom, and that's been responsible for the fact that in the US, shares peak to trough have come back a little bit more than 20%, about 22, 23%, caused by a downturn of anywhere up to 40, 50% on the tech side. So yeah, a correction in that market, which was a bit overvalued, but we don't think it looks like potential for a major one. But that will depend on the persistence of inflation and how high interest rates go up, and whether the reserve banks and the Federal Reserves have to go crazy. The markets were predicting the Australian cash rate would go up to about 4%. The Federal Reserve, the governor of the Reserve Bank, Lowy, has said, no, that's unlikely. And there's plenty of leading economists that think it will only go up to 2.5. A normal, and markets are never normal, but a normal long-term average in sort of reasonable conditions could be cash rate of 2.5, a bond rate, a 10-year bond rate of about 3.2, and share market returns, of 7, 8, 9%. That's normal. That's still possible, but at the moment, if the fear is if interest rates go higher than that for longer, it will slow down the economy and economic spending. It's an interesting chart I found because there's a lot of fear about what happened in the 70s. So I went back and plotted in a few different sources, but I've got this visual for you today. So what happened to share market returns in the 70s? And from 1970, when inflation started to appear, to 1983, when it was under control, we had a lot of volatility. So share markets were wild, but it was also one of the best periods for share investing in our history. And you can see this stacked bar chart shows share market returns in the different 10% ranges, 0 to 10%, where my cursor is at the moment, 10 to 20%, 20 to 30, etc. And you can see there's been times, not of recent, where the markets jumped 40 to 70%. Now, a lot of these times occurred in the 70s and 80s. We also had, so in that period, there was 4 negative years of between 10 and 30%. So, and that was 1970, 73, 74, and 81. But each one of those big downturns was followed by crazy up. So 73, 74, when the market was down about 25% for each of those years, was followed by 1975, where the market was up nearly 70%. Phenomenal comeback. And that then continued into 76 with a normal year. And then we had 77, 78, which were 20 to 30% returns, 79 and 80, which were 40 to 50% returns. Then a slowdown in 1981. And 1982, where's 1982 on here? It's right up there. Also a slowdown in the 10 to 20% range, followed by another 65% year. So in that period, if you held tight, you had very good returns, even though there was a lot of volatility. I don't think we're in for the same level of inflation interest rates. As I said, I can't be certain of that. No one actually can. But if we get a little mini bit of stagflation that comes out reasonably quickly, then we'll generally be followed by good share market returns as the market starts to look forward to more prosperous times. So that's a bit of history on sort of what happened there. Look, we talk about how most investors mess up their investments by all of these things, and the acronym of mess it up. The two I would remind us at this point is, once again, short-term focus and a single issue obsession. So that obsession right now is inflation and interest rates. And all these obsessions end up costing people money in the long run because they forget about all the other stuff that's going in the world. And yeah, we still get up, we're still doing our shopping, we're still traveling, we're still doing stuff. All of that goes to companies who can still make good profits. It's a tougher business environment probably in the next little while as we try and get inflation under control. But yeah, for most of us, it's still spend as per normal. And for many of us who've done okay and who've got money in the bank, and keep in mind, there's about 260 billion of savings in Australia built up during the COVID period. Some of that money is going to be spent. So that will offset some who will do it tougher. And the tougher ones are the ones who borrowed aggressively at lows. And I'll talk about interest rates and mortgages in a minute, who can't quite keep that up. They will spend less. But others will be spending more. And for a lot of retirees, they're now getting returns on term deposits that they haven't had before for a few years at least as well. I won't go through the care process. So Aussie shares were down 2.76% in May. They've obviously dropped another 500 or 600 points, about 8% in June so far. So we're going to end up, most of the gains of this year will be erased. So the June figures will confirm a pretty neutral to negative year, depending on what happens in the next few days. But when you look at the last 10 years, and this chart goes back to 2012, then you'll see that shares are going to cost. It's interesting, the joys of recording live. You just saw that my battery's about to expire. As I make sure I plug it in, there you go. My battery's not going to run out. Cool. So the share market has gone from $10,000 to nearly $30,000, $28,500 or $27,000 for the index over that last 10 years. So a stellar return, even with COVID, even with two other of those downturns that I talked about. The US share market, similar, actually higher growth, negative. It will be negative. Look at its recovery though. Keep in mind, this is the US share market in Australian dollars. So as the Aussie dollar gets weaker, which it nearly always does whenever there's a crisis on, this is a good thing for us. It acts as a shelter. So as the Aussie dollar drops, any drops in US shares are not as significant because they're made less by the drop in the US dollar exchange rate. So you'll see here the US market back to kind of where it was, not quite, but almost back to where it was during May levels. So they won't be quite as bad. You'll see the same for US small caps. It's bounced back quite well, but it still will be a negative month. And it will be a negative year for that as well. Global leaders, so the top 100 companies in the year, is nearly all the way back, which is fascinating. This is where the strength is. The Apples, the Microsofts, the Amazons, the Googles, as well as some of the big oil companies and some of the big banks and drug companies and food companies. And they're still doing pretty well. Valuations can be affected when interest rates are rising, but the market's bounced back pretty solidly in the last week from those lows of last week. And investment in these over the last 10 years has shown up, once again, 38,000 from 10,000, 3.8 times over that period of time. Emerging markets is where the real tough times have been in the last couple of years. So, over the last 5 years, you would have only had a 3% return. Emerging markets, we know, do outperform in the long run. They're still quite solid over the 10 years here, earning about 6.43% and taking 10,000 investment to be nearly twice that. So still pretty solid. We think these are cheap probably, but it's going to take something for it to come out. And that something is probably two major things at the moment. One would be an eventual resolution of the Russia and Ukraine war. Russia, of course, is part of the emerging market indices. And the other would be China coming out of its lockdown policy. which is keeping growth slower in China. Gold is fascinating. And when we talk about worrying inflation, we talk about the bond market not showing inflation worries, but the gold market isn't either. In the 70s, when we had rampant inflation, gold tripled and quadrupled in the first half of the 70s. So it went from about $20 to about $100. So it went up dramatically over that period of time. And gold's just hobbling along at the moment. So the gold market is telling us it's not worried about inflation. The bond market is telling us it's not worried about inflation. Short-term traders are saying they are, but I'd rather go with the long term than the short term, particularly as we are long-term investors. So interesting stuff there. In terms of property, I love this slide as always. I'll always leave it in because it shows that cycle, boom, bust, boring, that we get in property markets. There's lots of talk in the media about property crashing, and I'll talk more about what property is doing at the moment. But one of the big things here is mortgage rates. So this is the 3-year fixed rate tracked by the Reserve Bank of Australia and shown here from Trading Economics. And you'll see since September last year, when we were in COVID emergency rate still, and you could lock in 3-year rates at 2%. I'm glad that I did at that time, and I know a lot of you did as well. Rates gone up to 4.7% on average for a 3-year fixed rate. Now, that's not bad historically. And for those of us that have been around for a while, you kind of put that as a very good rate in the long term. It's tougher for those that have kind of got used to this. And a lot of the 2 and 3-year and 4-year fixed rates will come off over the next 2 years. And that will see people having to refinance. And you can still get variable rates at the moment about 3%. And people are asking us, should they fix? We're less likely to want to fix at the moment because rates have now gone up, and the 5-year fixed rates look like they've got a bit of fear built into them. So they may drop back if inflation does stabilise. But as always, hard to predict. What's happening on the immigration front, because that does drive property markets and the Australian economy. We're seeing arrivals and departures, as reported here by the ABS, the Australian Bureau of Statistics, coming back slowly. We're still probably not even, we're about, about a third of the pre-COVID levels. So we're coming back to travel, but not at a rapid rate. It is going up pretty quick. So it's going to be interesting. I know I have a trip planned for later in the year, as do many of you. So we're seeing lots more people starting to book overseas holidays, but still plenty of you that I talk to too that are a bit more cautious or less likely to travel this year. A lot of the time, not because of fear of any health issues, but just fear that the travel system isn't coping so well, fears of cancellations and refunds, etc., or just waiting to see how it turns out. So interesting there. This one I had in last time as well, but it shows population changes over the years. And this we see this typically net interstate migration, the purple, people going from Sydney and Melbourne to the smaller states, particularly Queensland and Western Australia, but much smaller numbers in the last little while. We expect that to rebound and should be good. Why is that important? Well, it's showing up in the changes here. So here's some data from CoreLogic on the property front, and you can see the top left-hand corner is the last weekly change. So we're seeing slightly weaker prices in Sydney and Melbourne. You'll see that for the overall last month. We're only talking about 1%. So that means $1 million property is only down about $10,000 on average. So we're certainly not seeing a crash. We're seeing a slowdown in growth, but certainly not a crash at this stage. When you look at the 1-year figures down the bottom left here, Sydney and Melbourne low, 6 and 3.5, but still solid. Brisbane and Adelaide, 25%. So still incredible growth over the last 12 months. Bottom right-hand corner, we can see the monthly change, and that's the solid blue line. And you can see its axis is on the left, so it's slowing down to be slightly negative, but certainly not going down gangbusters yet. And you can see the price of dwellings is peaking. So that's consistent with our theme that we think on average properties in Australia are going to go to sleep. In some areas they will go down, and that's probably more likely in some areas like Sydney and Melbourne. In some areas they may hold up pretty well. and that's probably going to be areas like Brisbane. Southeast Queensland in general, I think, holds up pretty well, and areas like Perth may even prosper, and Adelaide for that matter. So yeah, caution needed for investment properties at the moment, particularly around how you fund it and decisions with rates. But for those on high incomes who can benefit from the tax breaks of gearing into property, these rates are still historically low, and there's still pockets that represent good buying. So talk to us if that's in your zone at the moment. Still waiting on an update from here, but I think the ABS may be stopping this. I'm trying to find some other good data that shows, but this still shows the massive difference between the high growth states of property in the last couple of decades, Sydney, Hobart in particular, and Melbourne, and then the lower ones of Perth, Darwin, Brisbane. And you see they're catching up. And this is what happens. Markets do catch up. So there will be some opportunities. A lot of the media is very much Sydney and Melbourne focused. So they tend to just see what's going on there, and they miss out on the rest of it. So our friends at Heron Todd White now show Sydney at the peak of the market. You can see the changes here in orange. They do show the Gold Coast, interesting enough, is starting to decline, as is Melbourne, which is consistent with those numbers. They still show the Sunshine Coast rising, although I'm hearing from local agents we work with and people that it's plateaued, but it's interesting here. And other areas like Brisbane still rising, but approaching the peak of the market. So yeah, confirming those sorts of stories. So once again, the key message here is don't be spooked out by the short-term fearmongers. The long-term conditions are still okay. They're not brilliant, but usually when conditions get fearful like this, there's rebounds on the way. And I'm talking more about the share market here. I think the property market does have way less gains than we've had in the last few years, but that's normal. And anyone that holds property for the long term will still do well. Just to wrap up, as always, we believe firmly that all investing is best done as part of a real plan. It's based on your goals and what's important to you, and portfolio design to meet that with a long-term view and all the good, boring stuff that we like to do so you can get on with an exciting life. Diversification, the right asset allocation, liquidity. And the key is to not do the things where people lose money. The bottom here, panic and sell, have to sell, and not properly diversified. So these are testing times. I acknowledge that. Happy to talk to anyone that that's got any concerns about their portfolio. But we do think, as always, these things win. By holding the reserves that we do for our retired clients, means you're not selling good assets at a bad time. And by dollar cost averaging for our clients who are building up towards retirement, we're taking advantage of this discount by buying shares on sale. And anyone that's got good cash flow at the moment, there's some great opportunities, and talk to us if you've got money on the sidelines, because it may be a good entry point. That's it for me for this month. Happy end of financial year. It's been a busy one. Certainly the businesses we deal with have had good years. There's been a lot of activity in the last month, just helping them with their year-end tax planning. 2022-23 begins in a few days, and I wish you a good next financial year. I've got a feeling it's probably not going to be a bad one. It might actually be a really good one. Be interesting to see. Rob McGregor signing out.